Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right, so welcome to the Value Builder Podcast, Shea.
Yeah, thanks for having me.
Welcome all the viewers and the listeners. Whoever does not know, Shea is my partner. We're buying buildings for 5 years now, and we're deep right now into buying small industrial. So before we dive in, maybe you can give us like 2 minutes commercial, a little bit about your background. I know how you end up in small bay industrial.
Yeah, before you and I started working together, I actually got introduced to Saul as being an LP, but that, I'll get there. So I sold large scale data center infrastructure beforehand. Yeah. It was a lucrative career, did very well in it. So I had some extra cash. So I started doing, like little house hacking stuff and basically just caught the bigger pockets bug effectively. And then I started being an LP for you in some busing terminals that you guys are buying. Actually, just like 2 weeks ago. Yeah,
we refinanced the first deal, right?
Yeah.
Amazing. Got our old capital back?
Everything back.
And still cash flowing.
Yeah. So that kind of that's where I got introduced to industrial, right? So I approached you one day and I was like, hey, the other side of this LP-GP split looks pretty good on the GP side. Like, do you have any room over on that side? Yeah. And we had no relationship other than being LP-GP relationship previous to that. You were like, my industrial team, I have no job for you. I can't hire you. And I was like, that's fine. I'll just go and drum up deals. And you're like, not an industrial. Go. Have you ever heard of self-storage? And I had a tertiary understanding of what self-storage was. But long story short, I started calling it self-storage. I left my corporate career and I think we ended up buying self-storage in 6 different states and I had a few in each state. And it was I learned how to run a business as an operator doing that. I don't want to own any more self-storage. But along the way, some of those self-storage facilities, they had small bay industrial in them. So a couple of the buildings would be we would effectively call them contractor garages, but they were really small bay is what they were. A bathroom, small office, garage doors, 18-foot clear, all that kind of fun stuff. And those those were way easier to rent, less management, and that equated to more profits. So we started going and then, buying small bay effectively just as they're, solitary, not intermixed with self-storage. And the turns were just way easier. The lift was faster. The lease-up was faster. In a self-storage facility, we've bought stuff that's, 10% full and needs a bunch of CapEx. And then it takes you 2.5 years to get to, full. Just because there's a ton of supply out there. Small bay, we did 100% turnover when we would buy something just because our rents that we're taking people to are just market rents, which was what they're not being charged in place. So we would turn over the whole tenant base and that would take 6.5 months over the same size square footage. So the value add was far easier. So that's why, we like small bay.
Yeah, exactly. I remember it was in the self-storage space was almost industry standard was 3% lease up a month. I'm like, what? In small bay industrial, we probably can do 20% a month if you really plow, right?
Yeah, if you plow it. If you're really cooking it with ads, for sure.
Exactly.
And have some brokers on your
side. Exactly. Yeah, that's great. Yeah, that's been an amazing ride. And yeah, for sure. I enjoyed self-storage too. I think I learned a lot.
Totally.
We would not be where we're at if we would not know all intricacies with a self-storage. In renting apartments back in the day, I think there's some similarities.
I think there's a ton of similarities between small bay and apartments. Just we can get into it later, but I think leasing velocity is a big one, but also you have a bunch of diverse tenants and you have, you kind of equate that to a bunch of different asset classes. But I still own apartments. It feels a lot like renting apartments. Small bay does.
For sure. All right. So I think, let's dive in a small bay and why small bay. And I have a few points I want to, start going through. Let's start about, small bay and just main, bullet points to why we think a small bay for us it's a good deal and it's a good asset class to get in. So first of all, supply and demand. So the way I look at supply and demand in the small bay industrial is first of all, it's really cost prohibitive right now to build a small bay industrial. All right. So let's say if you're going to try to build in any part of the country, it could range between on the low and $100 to $130 all the way to $200 a foot, right?
Yeah.
And once you build at these prices, you have to lease call it, 15, 16 triple net, and really just too expensive for those small businesses.
Totally.
Let's say in Chicagoland, right now, probably see the prices increase, maybe, $10, $12, $13 triple net. But if you're going to build, you're not going to be able to make money. What it equates to, there is a lot of pent-up demand because just not enough product built.
Yeah, it just hasn't been developed. In a lot of the country, it hasn't been developed just because the economics aren't there to incentivize developers to develop. Obviously, you're seeing some markets that are, we're hyper local to Chicagoland.
Yeah.
And we've had stuff in South Florida. But, South Florida is getting overbuilt. I would say, down by Naples, some, corridors of Fort Myers for sure. And then we were just talking to Shea last week, and you see it in Houston too. Houston's got a bunch, and we'll get into a software that we have, but Industrial IQ, you look at Houston and it's just exploding with product.
Yeah, but also at the same time, because Houston, let's say Fort Myers, remember when we were going in last year, we could not believe about leasing pricing, right? Yeah. So the leasing pricing caught up to the economics where you almost can pencil out development.
Totally, yeah.
Let's say in Chicagoland, the leasing prices are still going up. Yeah. It's still not there where you can develop just because you're going to be losing share. And these, or you have to charge double to whatever, existing product is. So that's a great point. Another point I want to mention is that, and talking Chicagoland, let's say with the brokers and seeing what's happening, there was a lot of big boxes going on lately in the last couple of years. And if you look what was before there, some of them were small bay. So they just bulldoze those and they build right now. So that's not only no one is building, but actually in the last 3 to 4, maybe even 5 years, they developers started bulldozing those flex spaces or whatnot, building big boxes. So that's in terms of demand. Anything else we should add in demand?
Yeah, I think it's just I think that supply shortage. So we all know the GDP grows.
Yeah.
It's just steady growth rate over time. So let's say, I'm just going to talk about Chicagoland just because I'm educated in that. Even though Chicago in general is losing population, GDP is there's still a lot of economic production that's going on. Small businesses are still created. Trade businesses are still there, and they need places to go. So these businesses continue to either, one, there's more of them, or two, they just continue to grow. They need more space. Yeah. And when there's a fixed supply because nothing is getting developed, obviously there's greater demand. So if you have fixed supply, greater demand, that means the price is going to go up for rent. Right. So that's where there's an opportunity. And I think that's frankly why we really, really like small bays, just because there's tons of demand. With demand and a fixed supply, you can make a
then you don't have to do gymnastics on.
Yeah, you don't have to make a performa work. Exactly. It just works in an immediate calculation.
You can perform it in next, what happens in 12 months, 24 months. You don't have to forecast and hope for the best times. Yeah. Or low rates in 5 years, right? Demand is there. It's going to be next 12, 24 months for sure. All right, great. Yeah. So let's jump in another topic, and maybe you can take on this one.
Sure.
Market cycle resilience and tenant diverse the tenant base.
Yeah. So I think let's talk about the tenants, because I think that makes the asset diverse, or the asset stable over cycles. So the type of tenants that we have are a lot of service-based tenants, a lot of e-com tenants, and then just stuff that can't really be Amazonified. So for example, it's either stuff that is being sold online or it's stuff that can't be sold online. Those are our tenants that we have. So trades, you got plumbers, contractors, electrical supply companies, or it's people that are actually already selling stuff online. So we have a lot of online car dealers. They're not selling cars in the parking lot. They're selling cars, online, and they're just shipping them. You'll have, a podcast studio, or you'll have this is pretty morbid, but a veterinary, cremation clinic or something like that. So you have this abundance of tenant diversity across a bunch of different parts of the economy. But then, and we'll get into this a little bit later on, the inflation hedge, these companies that exist, their services that are necessary. Yeah. So they have some pricing power over their customers, which is important. We'll get into that later. But anyway, so you have a bunch of different tenants across different parts of the United States market and our economy. So that's where you get tenant diversity, just like a multifamily guy would talk to you about, hey, you got a bunch of different tenants and they all have a bunch of different jobs. Therefore, you're exposed and secured by a bunch of different parts of the market. Same deal here. Ours are just a little bit more local just because they're small businesses. So they are exposed, to that local economy, but it's just different sections of that local economy. And then the second part of your question was how does that make the asset more stable? Parts of the economy, in my view, I've totally could be wrong on this, but parts of the economy are constantly booming and expanding, and then some are obviously in recession at some points in time. So by just having diverse, let's say, segments of tenant base, you're diversifying your risk across all of them.
Now, another thing, just, it just popped in my idea in my head, which is actually memory. Do you remember the term essential businesses?
Yeah.
Yeah. So the first building I bought was Small Bay. It was 2020. We put in a contract in August, completely vacant. I closed in December. Remember the time, 2020?
Oh, yeah.
Everything was shut down.
Yeah.
We couldn't get out from house.
Yeah.
This was the first time I bought Small Bay. And when we started marketing this property, 99% of the businesses were not shut down. They were essential businesses. So then we look, let's say right now in our rent roll, we bought way more during those times. If you compare that rent roll, to any other asset class, most of your tenants are essential based. They just didn't shut down, not 100%, but they just tend to be essential businesses,
Interesting.
So yeah, so that was I remember good. Yeah, so that's another hedge against COVID,
How about that?
Exactly. All right, so let's go next. Let's talk about quick lease-ups. I'll take at that. Definitely, we mentioned a little bit about it, but lease-up is definitely much, much quicker than anything I saw in any asset class right now lately, because of that pent-up demand. So one is demand. Another one is that these tenants actually, you market business to business. So you market to business, but a lot of times they're small businesses. They tend to respond to consumer-based businesses.
For sure.
And our best marketing channel right now is Facebook Marketplace. Obviously, we market traditional marketing, brokers, LoopNet, Craigslist, stuff like that, right? But probably more than half of those tenants come in from Facebook Marketplace. So that's where we ramp up our leasing. And it's not unusual, as you remember, to schedule open houses. Once a week. What's our goal per property for how many tours?
We need five on a Friday afternoon, and somebody signs a lease.
Exactly, 5 a week and 1 lease. This is not normal in commercial real estate, right? When you talk to office guys or retail, right? They get a tour once a month and once in 2 months, and they dress it up, and it's a big. For us, it's a show every single week, right?
We're too ADD for that. I need action.
Exactly. So, but it's happening almost on every single asset. Assuming that's a Small Bay, 2,000 square feet to 3,000 square feet, and it's a good part of town.
I think there's a qualifier on that. So the size of the unit really matters.
Exactly.
So I think the technical definition of Small Bay, if you were going to go ask a brokerage, would be any unit that is from 1,000 to 10,000 would classify as a Small Bay size unit. The power that you're talking about of us being able to drive 5 showings on a Friday afternoon and create a little bit of scarcity amongst the tenants. I think that, in my experience, really exists for 1,000 square foot to 3,000 square foot.
Correct.
That's the sweet spot that we, our marketing channel, our direct to business marketing channel, direct to tenant marketing channel. We have a lot of power over that. And then when you get above that, brokers start to get involved because the checks are actually just...
Checks are larger,
The checks are larger, and they can make 10 grand on a leasing commission. And below that, it's not worth it for them to go chase us.
100%. 100%. Yeah, so we just kind of, put, summarize about lease-up. It's demand. It's you can drive leasing in-house, especially with a background from apartments or self-storages. When you're almost running a lease-up business in-house. That's very advantageous. And another thing, not necessarily I want to save on lease-up commissions. I really like to pay brokers, but we end up saving lease-up commissions because we are doing that in-house. It's just much more faster.
Yeah, and there's just less friction. So we talked a little bit about it, or we mentioned it at the beginning. We like it. We like the velocity of the apartments. How you rent an apartment is pretty transactional, pretty easy. It's just buying a TV.
Exactly.
Hey, I'm going to go look at a bunch of different TVs, and I'm going to decide which one I want to buy, and it's one price. And there's no breakdown in between, this is the insurance, and this is the all the component breakdown. That's how we do our leasing. We just go to the tenant. Hey, it's going to be $3,000 a month. You're here for 3 years. It's going to have annual bumps. And then on the back end, we start divvying things up in between triple nets and camp.
Which is a whole another topic. We probably should even do probably an hour
conversation. I think, that's a more in-depth thing.
But that's for sure. All right, cool. So let's take a stab at another one. Another thing I think we should chat, maybe you can take on it. Inflation hedge. I think that's a really important topic, for us, and why this asset class is.
So I think there's 2 things that stick out for me on it. One, from your tenants. So you got to collect your revenue stream is your tenants, right? So if you're going to constantly be jacking up rent, like that business that's going to occupy your space, they have to pass that cost on. And are they able to? Is like the real question. Can they afford it to stay in your space? So think about it like a plumber or an HVAC guy. Like if anybody listening to this has apartments or duplex or even their own house, if you replace an HVAC unit 5 years ago versus, today, I just got a quote yesterday from two separate guys, both 11 grand to replace an AC unit.
Crazy.
Yeah. Well, it was like whatever, like inside out and condenser. And then, 5 years ago, it would have been 8 grand, right? So like there is pricing that just goes up. How much of that is tariffs? I don't know. But my point is that service-based businesses, their customers, it's a necessary thing to consume. So they have pricing power to be able to pass on costs, regardless if it's tariffs or if it's rent. They have the ability for their end consumer to absorb that price increase. So I think that it's important that your tenants, you make sure that they have that pricing power over their customers, because then you are quote unquote hedged against when you have costs onto yourself, and you can pass it down to your tenants because they can ultimately pass it down to.
But I want to add to if you look at rent roll for the small bay industrial, actually predominantly those tenants, they have this power.
That's
it.
Yeah, that's totally my point. Exactly. I completely agree. Yeah, I completely agree. Yeah. What else was I going to say on inflation hedge? I think that there's, just for another thing, this is maybe not like necessarily like, you have one?
I have one. So if you look at small bay industrial tenants, we actually like no longer the 3-year leases. Sometimes we're okay even 1-year lease if we need to do what we call 2 times value add in the cycle, right? Let's say if we want to bump it up a little bit and then to the market, because those tenants they're turning like more often maybe than 20-year-old tenants. But at the same time, if they're charging more, it's so much easier for those tenants to catch up with market compared to someone you put maybe like, for 20 years. So if you're putting a apartment tenant, just residential tenants, it's hard for them to sometimes to get to market if you're not justifying with improvements. But in small bay industrial, what are the improvements? It's usually painting and make sure roof is, not leaking. It looks good from outside. Striping, asphalt, that's about it. That's your mainly improvements, right? And if the market is increasing, there is no additional supply. A lot of times, remember, we ask them to go on shop. They go shop, and they understand the pricing is there, and you don't have to negotiate much.
Yeah. All right. So that's a good tactic. All right. So when you buy a facility or a park or whatever you want to call it, you're going to go in there, you're going to do your light little lipstick ad, right? You're going to do the parking lot, you're going to add some paint, you're going to go change everybody's filters, you're going to do the light value add, right? Then everybody's scared because you're the new guy on the block, and like, are you going to yank their rents? Yes, you are. So how do you get them to either stay and have less turnover? What we do is we will do the light value add first. Then we will go to them and say, hey, this is where rent's going to go when you're, like you're month to month, or it's going to go at this time. Work out a deal with them. Maybe they have a step up in rent, whatever it is. But you're just going to get the objection like, hey, I'm at $9 a foot. You're taking me to 18. Like, what the hell? I can't do that. So what we do is we say, we totally understand if you don't want to pay our rent. Here's where the market's at. We give them as all comps that we use to underwrite our stuff, so that they have options to go look at it. If you want to go move there, you're more than welcome to go move there. But this is the price of the market. So here's we're not the bad guys. We're just informing.
Just go shop and see what's going on. And for sure, a lot of times we're still going to be below the market.
Yeah, totally, exactly. Especially with moving costs. It's just a headache.
Yeah, that's a great point. All right, so another point I want to address, and I'll take at it, is zoning constraints. And zoning constraints, just want to explain, is that small bay industrial, it has in the name industrial. And if you're going to try to approve in any municipality, virtually in any with a density, it's close to impossible to, let's say, change it from, more or less residential or some other use, some retail to industrial. It's kind of at lower end. So whatever is utilized for industrial, that's what you have. And if you want to add additional footprint in a municipality, you're probably going to go somewhere in cornfields. So that's why it has this another power, another moat in zoning, because if that's already was zoned as industrial, it's very likely it will have a higher demand or higher value because proximity to residential areas. Because small bay industrial, it's not like someone is manufacturer can be half an hour away. normally is going to be to the closer to residential areas. That's a service-based business. Maybe they're servicing the residential area, or maybe they're servicing another manufacturing industrial park. But in other words, it has to be somewhere not too far from residential areas.
Yeah.
And that's kind of rare. If it's planned 20, 30, 40 years ago, that's there. And if it was rezoned at some point, it's not going back.
Yeah.
So that's a really good moat, what I would call it.
I think
or
it's
small
a great
industrial.
moat. Yeah.
Anything else I can
No, I think that
Yeah?
I think you nailed that pretty good. I just don't. The only places I see it getting developed are on outskirts.
Exactly.
Yeah, I mean, unless you're in Houston or Texas.
Exactly.
No zoning laws. I'm just talking about Chicagoland around here, like Hinsdale or Downers Grove. They're not approving small bay industrial downtown.
There you go. Right.
Yeah,
Exactly.
it's just not happening.
Yeah.
So I think that's a good hedge. Yeah, I think it's a good hedge.
Okay. Another point I want to talk about, probably we can take at it, is a lot of big money getting in. Private equity. You mentioned a couple of deals to me in the last few weeks. I don't know. You want to take it at, why it's so important for us?
So obviously larger funds are going to go after, they need to hit returns for their LPs. So they're going to start chasing stuff that has the greatest demand and the greatest amount of, value add to be had with relatively least amount of effort, which is obviously what we're chasing. There's just bigger fish up the chain that are looking for that stuff. So I think it started, so PS Business Parks was, it was a public company that was back in 2022. Blackstone bought them. It was an amalgam of like business parks and had some office and had some multifamily, but net, like it had a lot of this like smaller bay flex stuff in there. So, okay, so that's a big headline, the big fish, Blackstone buying this type of asset. And back then I want to say it was, I don't know, it's a super compressed cap rate, but that's different interest rate regime. Now you see like bigger company or bigger private equity firms like BKM, for instance. They last year, I want to say they bought $2.5 billion worth of small bay, and inside of these business parks. And then this year, I think they're on pace to hit like $4 billion. So they had a big equity slug of $1.5 billion, and they're going out and effectively, rolling up a bunch of these business parks. And then what their MO is, I don't know if they keep it, retain it, or they go public or sell it. I have no clue. Yeah. But my point is like there is an institutionalization of these parks that's happening. A lot of them are mom and pop owned. Like why did we like self-storage at the beginning? Because the demand was high and we could go buy them there was a mark-to-market opportunity buying from a mom and pop.
Selling to big guys.
Professionalizing it and then selling it and adding value and selling it up the chain. That exists here. And it's not as institutionalized as like a self-storage is. I believe it will continue to get institutionalized. And with that, more people chasing these type of deals. I think if I were to have a crystal ball, I would say that these asset values are going to go up just because there's more people chasing them. So, yeah. Yeah.
And I want to add to that, and you've heard multiple times from me, but for viewers who did not hear it yet, I've seen this, what I say, movie, right? I've seen this in institutionalizations in housing, and Invitation Homes / Blackstone started buying homes. I was at the time believer that homes will never go back in their normal values. And when we started buying at those values and rolling in big pools, I'm like, well, they thought they crazy. Well, of course, they were not crazy.
Yeah, the smartest guys in the room.
Smartest guys in the room, right? No, they knew what they're doing now. I've seen this then, with apartments. Apartments were dead also after, big crash. And I think it was like 2011, 12, 13. It just heated up like crazy. Then it was with the self-storage. My first building I bought industrial. Industrial also was kind of, radioactive in 2017. And more institutional capital came in. Right now it's the, the most asset class that has the most demand. And right now I see it with a small bay industrial. And it's really just heating up. So if I look back in those movies, this is the time probably for 12 to 24 months, maybe 36 months until that margin is not commoditized. It's still kind of foggy. You still don't have crystal clear what they're buying at and what are the rate. The rates are so fragmented still in the market because it's not commoditized. 36 months from now is going to happen the same like with the with the self-storage.
Yeah.
We kind of know we don't know what leasing rates right now are all. And on top of that, big buyers got out of the market because of the cap. But these happens all the time. And I think this is the time, where we're kind of, at the cusp when it's just heating up. It seems like it's hot, but it's going to heat up and then it's going to get saturated,
Yeah.
And then there's going to be time to look for another.
And then there's another asset class.
Exactly.
It looks great. And I bet it's probably going to be office or something. Maybe regional malls.
There you go. Yeah. Exactly. No. But that's my take, and I'm super pumped about it.
Yeah.
Okay.
Yeah. I totally agree with you. I think that they're going to be they're just going to be more coveted because there's profit margin in them right now. Exactly. There's a lot of profit margin in them. You can buy stuff that's, renting at $9 a foot and take it to $18 a foot and convert it to triple nets. And then you exit at an 8.5 cap or whatever your given cap rate is in your given market. And there's a lot of, of value to be.
And you can do it without doing ground up from 9 to 18. It happens, right?
Correct.
A lot of times to go to that spread, you have to do ground up development. You don't have to do it right now here.
Yeah. So you can actually do the turns pretty quick if your leases allow you to.
Exactly. All right. I think that were great points. I think we hit the main ones. We probably, maybe the next time we're going to meet, maybe we're going to talk about, specific topics of lease up or operations.
I think something that where we find a lot of value is you take things from gross to triple net. But our buyer, our tenant, they're a small business. You're talking, the owner is the decision maker on the leasing. It's not like a big, spaghetti, organization. It's very flat and there's one person making the decision. They just want a price. So you give them that price and then you figure out how to do the breakdown of that, the nets and the cams.
I think that's a great topic. Yeah. So actually let's pencil in that we're going to go deep and we'll all meat and potatoes to know how we do that. But I think today I would like to spend some time on another project that's very dear to your heart and mine too. But it's really, you started, baby. I'm super pumped about it. It's Industrial IQ. So let's dive in Industrial IQ and do the same way. Let's pick bullet points and let's go through that. So Shea, first, what is Industrial IQ? Tell whoever doesn't know about it.
Yeah. So what Industrial IQ is, it's the only nationwide database of small bay properties in the world for the United States. We think right now that there's about 150 to 200,000 acquirable small bay parks in the United States, which is actually pretty big.
Storage
is like 60,000.
Exactly. Yeah.
Anyway, so only nationwide databases of small bay. We have all the leasing data for stuff that's actively being leased out there. So you can quickly jump from market to market to figure out what you get sent a deal. You figure out what you can underwrite that deal to from a rents perspective. And then we also have demographic data, but most importantly, we have owner data and sale data. So we have a cell phone number for the owner that you can call, and then the last sale data if you want to look up comps. So that will be rolling out in the next few weeks here to some beta users. We're excited about it. If anybody out there is familiar with like Radius Plus or StoreTrack or in the self-storage industry, it's the Radius Plus for small bay. And the reason why we were doing this is because we couldn't find a small bay list out there to go call. It was very manual to create one. You go to CoStar and then you sift through, 500 at a time and you export them and then you got to put them in your CRM and it's just very cumbersome to do it. What we did is we have a couple of developer partners who are very smart with AI, and we have AI that goes around and looks at the outsides of every single building in the United States and tells us what it is. Yeah. And that's how we make our list.
Do you mind if I share a little bit how actually it started? It has prerequisite with self-storage. So I would say initial idea. So this is just like, 2.0 or 3.0 of our self-storage acquisition tool. Yeah. Which is right now with AI, automated, 100 times faster. I don't know, a gazillion times more accurate. But if you remember, we started creating Google Sheets for small bay, for self-storage, because self-storage list was not available to them. Yeah. And we crawled literally, which with wow VAs via Google Maps, and we uncovered LLCs, and it was so tedious and so slow.
Very manual.
Exactly. We got to like 5,000 lists. How many we got?
Yeah, I think it was like 12,000.
Okay, 12,000.
Yeah. But then tools like Radius came out, stuff like that. So, then that rendered us like our manual thing was obsolete. We're just doing.
But exactly, our list anyway was unique, meaning no one had this list. And maybe of that 12,000 list, on CoStar, maybe you would find 30, 20, 50%, maybe not even that, right? Yeah. There's so many properties were not existing on any platforms or anywhere using hatch.
Yeah, it wasn't on Google Maps, so you couldn't scrape it.
Exactly. Yeah.
And that's why, that's how all those, how does a self-storage list get created? They just scrape Google Maps.
Exactly.
So you can't scrape Google Maps for small bay. That doesn't work.
Exactly.
So you need
AI
intelligent machines to go and do it, which is what we do.
Yeah, and it's being created much faster now. Because of that.
Yeah, so right now we're adding about 6,000, maybe just shy of 6,000 small bays every single week to this thing. I'm sure it'll be up at 150. Right now we're just under 50,000 this week. So we'll be upwards of 100.
So 251, do you think our guy is going to get 250?
I don't know if there's actually 250, to be
okay.
honest
All
with
right.
you. So we're not collecting anything that's below 10,000 square feet. That's kind of just like I would never buy that.
Exactly.
I'm making this thing for me, right? And we're making this thing for us to go acquire stuff. So I would never buy that, so I'm just not including it in there. I really think we'll be at that full saturation. I would say within 2 months we'll be fully there. Yeah, we'll be fully there.
Amazing. I can't wait. I get to use it.
Yeah,
what we have right
course.
now, right? So I'm pretty sure a lot of folks know waiting for it. Now, I bet many folks right now asking in their head, no, so why are we sharing it? Because in the self-storage route, remember, we kept that tool for us.
Yeah.
And we didn't share it.
Yep.
Eventually, we bought it only in 8 states or whatnot. And we thought we were going to buy all the states. Yeah. And when it got saturated, we eventually sold that list for very, very little money when we get out from self-storage, right? Yeah. So why are we sharing this time right now? We actually open up as
so
as a license.
Bottom line, I mean, we think that there's over 150,000, like somewhere between 150 and 200,000. We're never going to acquire. Like we're not a big private equity firm, right? Yeah. So like we're just going to be in our own little like backyard. We can do very well in our little small little sliver of the world. So that's one. Two, we're going to roll up our portfolio in a couple of years to go, sell it to somebody who will hopefully pay a great cap rate. But they're going to pay a way better cap rate
than we get a market.
If we were to, have other folks join us in our roll-up. So what we'll use IQ for is we'll use it, number one, to go acquire our stuff. Number two, we're going to roll up our portfolio and we'll use IQ to tell other folks, like, hey, we're going to go sell it this time. If you want to jump on and sell with us, maybe we can get an extra 50 bips less or 100 bips.
I'm aiming for 100 actually.
If it's 100 basis points of cap compression, I'm in.
Yeah.
So I mean, frankly, like you're not getting rich off of the software. Like where we're going to make our money, where we make our money is in equity creation of these assets. And if we can get an extra 100 basis points by using it as a megaphone, that's what we're going to do.
Yeah, and if we can collaborate with amazing people and amazing operators, which we actually had in our first boot camp. I was shocked and surprised.
Yeah.
How many cool people we had, right?
Yeah.
It was amazing, really. And collective intelligence comes out from that. We got some cool ideas about the software. So that's another aspect besides those two,
so what a couple of people were saying, Darren in particular, was like, hey, if I can mail from here, it'd be really great. Like, all right, so what you guys have created a nifty little tool. You basically created a list, and that list tells us, what the lease rates are in any given area, and you give us some owner data and sale data on it. That's great. It's an acquisition tool. It's really what it is. But there's no marketing section of it.
Exactly.
So like you make the money is obviously you make the money on the buy, but you got to fill the thing up in order to do it. So what we have heard from the folks at our bootcamp was like, hey, if you could include a ability to send mail and just do like a mass mailing for, just circle a radius. I don't want to mail every single person in here. Type in what I want the message to say, and then we have an integration with, whatever mail house. That would be really nice. And then what we also do to lease our stuff up. So Saul mentioned Facebook Marketplace. I think that's the number one way that we do it. Number two, we have VAs that are, in our back office who are constantly hitting contact us forms on plumbers' websites. They're emailing any public email that they can find. Or DMing on Facebook and Instagram. So if we can have the platform, just you be able to talk to the LLM and the platform and just say, hey, I want to reach out to every single plumber in a 10-mile radius from my site. It's a 5,000 square foot unit, costs 10 G's a month. Just go reach out. Yeah. And then it just has an agent, and then the agent goes and does the work. It makes it way easier for operators to actually use it from acquisitions and then also use it in operations, which just makes you more money faster.
I think it's definitely, I would put this one probably like a wish list,
Yeah, totally. That will not be in a couple of
weeks. That will be, if we can have it, I don't know, next year, like first quarter of Q1, that would be great. With direct mail, I think we talk to people, Pioneer Direct.
Yeah, so direct mail is going to be within, when this becomes publicly available, direct mail will be a part of it.
Yeah, and again, we don't have any, any markups, anything like that. We're just going to share what's worked for us, and we use the same mail house, and just hopefully for the folks who are in small bay industry, it's going to work. Yeah, so I'm really excited about that. I think I really enjoyed this format.
Me too.
We just did it on the go, right?
Yeah.
We didn't prep for it. I think let's see how that will be received. We're gonna see from comments and from views, but I'm game to do another one, maybe another month, right?
Yeah.
We can dive in deeper.
Yeah.
And actually even report numbers from IQ and, you know, especially.
Yeah, because we're going to be rolling that out in I think it's 3 weeks. I'm like the 20th of July.
Mm-hmm.
We're going to get it into people's hands.
And today we're July 3rd. So I think this episode should be out within a couple of weeks. No?
Okay.
Yeah.
IQ may be available, but it's only to beta customers. Yeah. It's not, they're beta users.
And our first one's going to be the ones who are with
in the boot camp. Yeah. Yeah. So that'll be for the boot camp folks.
All right. I think I really enjoyed it, Shea. Before actually we leave, where people can find about Industrial IQ and where can find you? Yeah.
So industrialiq.ai. That's the URL that you can go to. And then for me, you can just reach me at Shea at zequitygroup.com. That's our company, Z Equity Group.
All right. Awesome.
All right, brother.
Thank you.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.